Morning, ladies and gentlemen. Welcome to this Monday's weekly morning call. Today we'll first start out with our weekly updates on the Sembcorp Marine. Sembcorp Marine releases its first Q results. Okay, testing. Can you hear us? If you can, please say something. Type some questions.
I think it's okay.
No?
Testing 1 2. Testing 1 2. You said everyone will be lost. Testing.
Hi. Can you guys hear me? Good morning, ladies and gentlemen. Welcome to our weekly market watch. Today we'll first start with our earnings update. Sembcorp Marine releases its first Q results last Friday, and we publish our report this morning. Sembcorp Marine's first Q result is slightly below expectation. Flattish Q-on-Q margins. Its first Q net earnings is $122 million, up only 3.1% year-on-year, down 33% Q-on-Q amid higher sales recognition. This is partially offset by the weaker operating margins. Margins, even though it remains flattish Q-on-Q, but it's down from the 13.7% in first Q last year. The lower margin is mainly due to the conservative revenue recognition for its two Brazilian drill ships, as well as a few new drilling rig projects. We believe that our operating margins will continue to remain under pressure going into the second half of this year, particularly due to the fact that Sembcorp Marine is going to execute its first drill ship over its new Brazilian yard in the second half of this year. Any potential upside for Sembcorp Marine will come from better execution, better project execution, which will in turn lead to higher margins. Sharp, prolonged increase in oil prices. This will actually increase the appetite of E&P spending for oil companies, as well as stronger than expected order wins. We maintain reduced for Sembcorp Marine with a target price of $370. Next, Caroline, more on HoBee.
Has released its result on the 28th of April last Monday, and we have published a report last week. So for HoBee on the whole, the first quarter this year has actually underperformed our performance. The revenue is for this quarter is at 17.1 million, and the PATMI is at 4.1 million, a drop of 72% and 94% year-on-year respectively. Reasons attributed to as there's no development projects being sold in this quarter, so there's no revenue recognition. Looking deeper, we will realize that there's also a gain on sale of 47 million in last year first quarter, and this year they also have an increase in the operating expenses of close to about 150% increase year on year due to the fees for refinancing of loan for the Metropolis. And for the rental income this quarter from the investment properties, it has actually increased from 2.7 million to 15.9 million, mainly attributed to the rentals of the Metropolis and the Rose Court. So looking beyond this quarter underperformance, the rental income from the Metropolis actually has yet to contribute to its full potential, as we understand that some of the tenants will only be moving into the premises later this year. So moving forward, the rental income should improve in the coming quarters with more tenants moving into the Metropolis, which is already currently 94% leased. And also from the contribution from the New London office acquisition, the one SMRT Le Grand in the first quarter this year. Considering the rental income from the two, we believe that the performance for the coming quarters should be much better as compared to this quarter. We also understand that HoBee will be launching the overseas China and Australia residential project this year, and the development income from this residential project will contribute significantly towards the HoBee earnings in the financial year 2015 and 2016, being that overseas project, they will only recognize the revenues after the project is completed. So for HoBee this year, they are actually looking at in two areas. One is on the rental income to improve the to build on the rental income from the investment property. They mentioned that they will still be looking overseas for local and overseas on this area. For London, maybe still London as per normal, and for overseas project, residential project, they will be looking at Australia likely on the residential projects, being that Singapore currently the residential market is not really doing well. So likely for these two, they will be looking at overseas projects to build on the portfolio. So for this after this quarter, we have actually revised the revenue and the net profit downwards by 15% and 24% for this year, for the financial year 2014. We maintain our accumulate rating with the target price at unchanged at 2.51 paired to 35% discount to RNAV. Next, we will cover on the banks.
Sorry, Benjamin here. Yeah. So good morning, everyone. Benjamin, your financials analyst. So the three local banks reported their first quarter results on the eve of Labor Day. So DBS and OCBC showed a very, very strong start to the first quarter 2014, and UOB had a bit of a milder response to the first quarter. So first off, we start with DBS. Okay, first quarter net adjusted earnings was about 1.03B, and this beat our expectations about 14%, and it beat consensus by about 13 to 14% as well. Right, so the beat is largely on the non-interest income, and provisions was flat quarter on quarter. Right, so some of the key things are that loans growth is still on track at 2% quarter on quarter. So recall the last time when I gave a talk on DBS, the management is guided for 8 to 10% growth, loans growth year on year. So 2% quarter on quarter is pretty much on track. All right, the positive thing is that net interest margins have improved 5 basis points to 1.66%. So previously, I was mentioning that the net interest margins have been stabilizing for about 3 to 4 quarters during FY13. Then we expected a bit of an upturn. So this was came as a surprise. They jumped 5 basis points. Okay, so a pretty large jump. So I'll elaborate a little bit more later. And the net interest income has rose consequentially by 2%, okay, due to loans growth and net interest margin growth. So the non-interest income has improved 76% quarter on quarter. So this was a major surprise. Okay, this largely came from the strong customer flows from the treasury side, right, as there were more customer trades. Okay, so credit quality is still intact. NPL ratio doesn't change by 1%. So previously, at the start of the year, FY14, there's a major sell down of the DBS counter because most investors and the market is concerned about DBS China exposure to the shadow banking as well as the trust products. Right, so in terms of the choice between the banking counters, most switch over from DBS to holding UOB instead, right, for more resilient earnings and less exposure to China. So now that DBS has reported its first quarter earnings, it has shown that its asset quality is still intact with very robust asset quality basically. And so it proves that the concerns of the China exposure is very much undue from the market. Alright, so some of the key takeaways that we have. So first up, I'll touch on the NIMs as I promised just now. The net interest margins have shown a huge increase, but we think that this is largely we think this is not sustainable because it's largely due to the increase in the overnight money market rates by the PBOC during the end of last year, we spilled over to the start of this year due about Chinese New Year period. Alright, so during the point of time, PBOC raised the overnight rates between 6 to 7%. Alright, so this allowed DBS to take advantage of these gapping opportunities to price up these spreads on their loans. So now that the overnight rates have come down, we think that it's not likely to be sustainable at these 1.66% net interest margins for the rest of this year. Alright, so I think that this will probably ease off from 1.66%, unlikely to be sustainable throughout the entire year. So the next one will be the high quality trade book. Okay, DBS has done a lot of stress tests on it, making sure that they have no exposure to companies involved in shadow banking or the trust products. Right, so we don't expect NPL ratios to take up too much from here. Right, so it should be roughly flattish for the entire year. And then one of the key things also is strong deal flows in the pipeline for DBS. Very strong M&A this year. They've been being the lead of the league table, right, this year for issuance of RMB denominated bonds, right, and very strong M&A activities as well, right, for the investment banking arm. So with that, DBS still remains our top pick for the banking sector. Rating is still accumulate. Our target price is revised upwards from 18.48 to 19.01, right, because we slightly revised the earnings outlook for the year. So it's currently still on the accumulate rating. Next up will be OCBC. Right, OCBC also beat our estimates on higher expected profit from their insurance arm, which is Great Eastern, as well as lower than expected provisions, as asset quality did not change much, so provisions didn't move much as well. So the loans growth momentum is still strong, about 2 or 3% this quarter. And net interest margins, same as DBS, also jumped 6 basis points, but there's a slight difference to here, which I will touch on later. Then deposits are growing quite healthily as well. They are building up their current account and saving accounts balances. And if you guys have been noticing, OCBC 360, which entices you to put in 50k of your savings as well as doing all the different transactions through it. Right, so this is how all the banks are basically competing on to fight for deposits. So fees and commission has been very strong. Right, Bank of Singapore has been generating very strong wealth management income for OCBC, as well as their bank assurance, which is selling insurance through the bank. So some of the key takeaways is that the net interest margins also showed a big jump of 6 basis points. The difference is that we think that for OCBC, 50%, roughly 50% of this increase in net interest margins should be sustainable, because half of this contribution actually came from an increase in spreads that are charging to the corporates, and only about the rest of the 50% is coming from the gapping opportunities when PBOC raised the overnight money market rates. So therefore, we have slightly shifted our net interest margin forecast by about 2 basis points, right? Because we believe that 2 or 3 basis points of this increase is sustainable, okay, throughout the course of FY14. Next up will be management is a bit cautious on Malaysia and Indonesia, as they're seeing a lot of margin as well as funding pressure, because competition between overseas as well as local banks for deposits are heating up. Alright, and last of all, we still think that the Wing Hang Bank acquisitions remains an overhang on the share price, as it's not yet determined how much they will fund via equity, right, by the time the acquisition is completed. So we still maintain a rating of OCBC at neutral, as we are a little bit cautious on how they're going to fund the acquisition. So our target price is revised slightly upwards to $9.74, right, for OCBC. Last of all, for UOB, a little bit disappointed on the results. Okay, first quarter net profit came at 788 million, 2% improvement quarter on quarter. Alright, but it beat our expectations, but we felt that the beat was a bit of a low quality, on the low quality side, right? Because the beat expectations was from them doing a one-off disposal on their Malaysian insurance JV, and some of the tax write-backs that they have. Right, so net interest margins differed from the other two peers, came in at 1.73%, largely stable, but one basis point down quarter on quarter. And management is a bit more bearish on their net interest margins, so they expect it to end flattish throughout this entire financial year. Right, so they state that that was due to the outlook from the pressures that's coming from overseas, which flows back to what OCBC has mentioned as well, that there will probably be a little bit of funding pressure from the overseas franchises. Right, so for UOB, I mean, we still like their very cautious and conservative business approach, which we think forms a bit of a support for their resilient earnings. And their fees and commission have shown very strong traction throughout the course of last year, and management is still pretty positive on showing double-digit growth for this year for fees and commission, even though we acknowledge that they started off the year on a slightly slower head start compared to its peers. Right, so some of the key takeaways again, let's look out for funding pressures and margin pressures from all areas outside of Singapore, especially Indonesia as well as Malaysia. Right, and UOB still remains a proxy. Basically, UOB is the ASEAN story play because of the least exposure to China compared to DBS and now OCBC with its exposure through Wing Hang Bank to China. So previously, investors in the market supposed to hold UOB, right, because of the concerns with DBS China exposure. But now, right, that these concerns have been until we think that the market would prefer to hold DBS, right? And anyway, DBS still remains a topic as it's largely undervalued, as well as it remains the key beneficiary to any interest rates hike due to its highest percentage balance of current account and saving accounts, meaning that its funding cost remains the lowest compared to its peers. So therefore, UOB has about 13 to 14% share price run up over the last 3 months, and it's pretty near our target price. All right. So there's not much upside left, about 3 to 4%. So therefore, we've downgraded our call for UOB from accumulate to neutral. All right. So that's it from me, and I'll hand over to Richard to take you through the bulk of this presentation.
Hi, good morning. This is Richard, analyst for transport. So now I'll speak to you a bit on the results for SMRT full year FY14, which was announced last week on Wednesday. So you can see the revenue was at 1.1 billion, up 4% from the previous year. Operating profit 84 million, down 34% from the previous year, and net profit 62 million, down 39% from the previous year. So what we are seeing is that there's been modest revenue growth, but significant drop in their operating profit and net profit. So this is their divergent top line and bottom line. This was attributed to their fare business posting a full year loss of 25 million. What their fare business consists of is the MRT, LRT, and bus business. In addition, this fare business loss was due to the lower rail profitability that was dragged down by an unprofitable bus business. What we see is that the current rail and bus models are badly in need of a revamp by the regulator, and we maintain our sell rating with a target price of 90 cents. I'd like to take some time to go into further details on this lower rail profitability and the unprofitable bus business. You can see here, this is the operating profit loss for FY13 and FY14. In the previous year, the MRT business had 65 million in operating profit, but in the most recent FY14, it shrank to 5.5 million. As for the bus remained unprofitable, but they did manage to turn around some of their losses. So from 31, it became 28. If you add these three numbers together, this is where you'll find the 25 million of operating loss. In the previous year, when they had 65 million of operating profit in the MRT, they were able to book a operating profit still for their fare business. And now if you look at FY14, you will notice that for their operating profit of 84 million and you compare with their rental operating profit, you will see that most of their profits for SMRT now is coming from their rental, and then second is from advertising. Okay, now I move on to our presentation for the Singapore land transport sector. We just want to highlight to you that we reinitiated coverage on SMRT and Comfort Delgro last week. So that's why we're giving this presentation. I will introduce you to the company of SMRT and Comfort Delgro, and lastly I'll give a presentation on the land transport sector for Singapore. Okay, so SMRT previous close last Friday was $1.24.5. We currently have a target price of 90 cents for SMRT. Company background: SMRT is a multimodal land transport operator in Singapore. Its business is split into two components, the fare business and the non-fare business. So for fare, it's MRT, LRT, and bus. Non-fare is taxi, advertising, rental, engineering, and other services. In addition, SMRT has a stake in overseas associate Shenzhen Zona Transportation, which also does transportation business. Go into further details of their MRT and LRT. So SMRT operates two MRT lines, the North, South, East, West line and the Circle line. And for the LRT, they operate the Bukit Panjang LRT. The Bukit Panjang LRT is connected to the North-South line at Choa Chu Kang Station. The LRT acts as a feeder service to transfer passengers who live in that area onto the main line, which is the North-South line. For calendar year 2013, SMRT had 78% market share of rail ridership in Singapore. SMRT provides public bus service through its wholly owned subsidiary SMRT Buses, which was formerly TIPS. Their services are concentrated in the western and northwestern areas of Singapore, and they had 26% market share of bus ridership in calendar year 2013. Now we move on to the non-fare business segments for SMRT. SMRT rents taxis out to taxi hirers, and they have 13% market share. SMRT has an average fleet of 3,300 taxis for FY14. They earn revenue through rental of taxis to the hirers. Revenue for this taxi segment is driven by fleet size and newer vehicles. So if they have more vehicles, they will have higher revenue, and when they replace the older vehicles with newer vehicles, they will rent the new vehicles at a higher rate to the hirers. Next, we have rental, which is the leasing of commercial space at MRT stations and bus interchanges. These spaces include shop space, event space, push carts, and flyer distribution points. So SMRT had an average of about 36,700 square meters of lettable space in FY14. Leasing of advertising space. So SMRT leases advertising space on the trains in areas such as the panels, window stickers, and hangers, and also in MRT stations like panels on the wall and on the screen doors. They also have advertising space on their taxi and buses. SMRT also has an engineering business which provides consultancy, project management services, leasing of fiber optic cables, and repair and maintenance services. They have local contracts to install fare gates and leasing of fiber optic cables. For the installation of fare gates, SMRT actually has won the tender to install the fare gates at the new Jurong Regional Line. For their overseas exposure, they do technical consultancy, and they also operate the personal rapid transit system in UAE. Finally, they have these other services, which is external fleet management and Bus Plus service. The Bus Plus service provides ad hoc, scheduled, and chartered service. This is separated from their public bus service, which is fare revenue based. This is contract based. Lastly, we'll look at the revenue and profitability of SMRT for FY14. Here in the pie chart, you can see that 54% of SMRT's revenue came from MRT fare, and this was 624 million, but they only ended up with 5 million in operating profit. And if you look here, majority of their operating profit comes from their rental business, which has the highest margins. Now we move on to valuation and investment actions. So we value SMRT using the historical PE at 17.9, and we have a 2-year horizon. Why do we have a 2-year horizon? We believe that the extensive infrastructure replacement and asset renewal program should be completed in 2 years, and that's when their operations should be stabilized. currently have a sell rating on SMRT with a target price of 90 cents. But what upside catalyst we see to improve the valuation for SMRT would be the change in the rail model to the asset-light model, change in bus model to the contracts model, and successful tender to operate new MRT lines. Next, we move on to Comfort Delgro. Comfort Delgro previous close last Friday was $2.07. We currently have a target price of $2.34 with an accumulate rating. Okay, company background for Comfort Delgro. It was formed in 2003 when Comfort Group and Delgro Corp merged, and it's currently a global player in the land transport arena, operating in 7 countries: UK, Ireland, China, Vietnam, Malaysia, Australia, and Singapore. Comfort Delgro also operates across 8 businesses, which are bus station, taxi, rail, automotive engineering services, inspection and testing services, car rental and leasing, driving center. This is a snapshot of their revenue and operating profit for the recently concluded FY13. You can see that 60% of their revenue comes from within Singapore and 40% from overseas. This is the makeup of their revenue from their overseas business. You can see that most of it comes from UK and Ireland, second Australia, third China. Their Vietnam and Malaysia businesses do not contribute much to their total revenue. For their operating profit, Singapore makes up 51%, while overseas 49%. What you can notice as you look down from revenue to operating profit is their overseas business is now has enlarged its share of the operating profit, and this tells you that their overseas business has better margins than their Singapore business. Go into more detail on the Singapore businesses of Comfort Delgro. So like SMRT, Comfort Delgro is a multimodal land transport operator. It operates MRT, LRT, bus, taxi, and it has other services such as the automotive engineering services, vehicle inspection and testing services, car rental, and driving school. Okay, for the MRT, for their fare business, they have their fare business through their 75% owned subsidiary SBS Transit. So SBS Transit operates the 2 MRT lines, which is Northeast Line and Downtown Line, and it operates 2 of the LRT systems, the Sengkang and Punggol LRT. SBS also operates the buses in Singapore. They have about 3,300 buses, 255 services, servicing 17 interchanges. SBST also, just like SMRT, earns revenue through advertising and rental on their buses and at the interchanges and stations. In addition to the fare bus, Comfort Delgro also has a bus subsidiary, Comfort Delgro Bus, which provides chartered bus service. So these services include staff transport, school bus, sightseeing tour. They recently also started the City Direct services and the peak period short service, which comes under the BSEP, Bus Service Enhancement Program. For taxi, Comfort Delgro has exposure of the taxi business in Singapore through 2 companies. First is their wholly owned subsidiary, Comfort Taxi, which has more than 12,000 taxis. And second, they have CityCab, where they have 54% share in the JV with ST Kinetics, and CityCab has 4,200 taxis. Combined together, Comfort Delgro has exposure to 16,600 taxis in Singapore and is the market leader with 60% share of taxis in Singapore. So if you go out on the street these days, you'll start to notice that most of the taxis you see in Singapore actually are either Comfort or CityCab taxis. Just like SMRT, revenue is also driven by fleet size and newer fleet. And ComfortDelGro also reports that they are increasing revenue through cashless payments, where passengers pay for their fare through cashless payments and they get a merchant card. Two of their services in Singapore, automotive engineering services and vehicle inspection and testing services. So they have engineering services through their wholly owned subsidiary ComfortDelGro Engineering. Some of the services are car grooming, servicing of private cars, and accident repair. For their vehicle inspection and testing services, it's through their 67% owned subsidiary Vicom, which is also listed on the Singapore Stock Exchange. Vicom has 7 vehicle inspection centers in Singapore, and ComfortDelGro reported that this business segment saw good business when the COE premiums rose sharply as small car owners did not scrap their vehicles but sent them for inspection instead. Lastly, their last 2 businesses in Singapore are ComfortDelGro Rent a Car and the Driving Centre. So the car rental business has about 1,100 cars, and it's the largest car rental and leasing operator for passenger vehicles in Singapore. ComfortDelGro also has a driving centre which is 90% owned. There are 2 branches, HoBee and Kovan. Revenue is earned through student enrollment as well as conducting driving courses for institutional customers. Now I move on to the overseas business for ComfortDelGro, starting with China. So ComfortDelGro operates in China in 12 cities across 6 businesses. There are taxi, bus station, driving center, bus, vehicle testing services, and lastly car rental and leasing. I'll only speak there are 2 main businesses, taxi and bus station. So ComfortDelGro is the largest taxi operator in China, and it is the largest overseas taxi revenue source for ComfortDelGro. Their taxi business in China has better operating margin than their taxi business in Singapore. As for bus station, they operate a bus station in Guangzhou, and revenue at the bus station is mainly earned through ticket sales commission. This bus station has the highest operating margin among all of ComfortDelGro's businesses. Moving on to Australia, there are 2 main businesses in Australia, is the bus and taxi circuit. Their bus operation in Australia is different from Singapore in that it's already on the cost plus model. So there's contract indexation and there's no ridership risk. Their bus operations in Australia has the highest operating profit margin across all of their bus businesses. Next, about their taxi circuit, it is also different from Singapore's taxi business model. Here in Australia, ComfortDelGro does not own the taxis. Instead, the taxis are owned by the taxi drivers themselves, and they do not rent the taxi from the operator. How it works is that the taxi drivers will pay a subscription to have access to the call center and have access to client bookings. Their taxi business in Australia has the highest operating profit margin across all of their taxi businesses. UK and Ireland, for their bus, which includes Intercity Express coach in Ireland, it has the highest overseas bus revenue source for ComfortDelGro, and the operating margin is also better than the Singapore business. The UK public bus operations are similar to the Australia one in that they are on the cost plus model with contract indexation and without ridership risk. Taxi circuit in the UK works on the exact same principle as that of Australia. Lastly, Vietnam and Malaysia, which I mentioned earlier, they do not contribute much to the total revenue of the group, so I won't spend much time speaking about them. But just to introduce to you, in Vietnam, they have 2 taxi companies in Ho Chi Minh City, and for Malaysia, there's car rental business in Kuala Lumpur and inspection and testing services in Puchong. So this is what the performance for ComfortDelGro over the last 5 years. You can see that all their businesses have are profitable across the last 5 years, and as for by geography as well, all the geographies are profitable. Last 5 years, EPS and DPS has grown as well, with the last payout ratio of about 56%. But what about the future? So these are the opportunities for growth that we see for ComfortDelGro. One of the game-changing things would be the change in the bus model in Singapore to the contracts model. And as you know, there are new MRT lines being constructed, so they should successfully tender for new MRT lines. And as I showed you earlier, their UK and Australia bus operations are profitable, so they should be able to leverage on any M&A opportunities. We hope to see that corporate bookings in the UK and Australia improve, so that this will lift their profitability in this area for the taxi circuit. And lastly, they are always on the lookout to acquire more taxi licenses in China. We value ComfortDelGro using discounted cash flow, and we have a target price of $2.34 with accumulate rating. Our investment merits for ComfortDelGro are, firstly, it's one of the world's largest transport operator, and the businesses are diversified across types and geography. They have strong overseas land transport operations with profitable margins, and the management seeks out inorganic accretive opportunities where they can have majority control. ComfortDelGro is also the market leader for taxi in Singapore with about 60% market share, and they already have a foothold in the UK and bus business. Why this is important is these 2 businesses are profitable, and they have already proven themselves to the local government that they are able to run the public bus service effectively. So they are a strong contender if and when the local government opens up new routes. Lastly, we see year-on-year EPS and DPS growth with a sustainable payout ratio arising from their positive operating cash flow. Okay. Next, I move on to the presentation on the Singapore land transport sector. There will be 4 parts: market structure, historical industry trends, and I'll speak a bit on the asset-light model. For rail, it's a duopoly between SBST and SMRT. I've spoken about what lines they each run. But recap, SMRT is a market leader with 78% share of the ridership numbers. Buses also duopoly between SBS Transit and SMRT, but this time around SBS Transit is the market leader with 74% share. Bus routes have been centrally planned by LTA since 2009. Taxi industry in Singapore is an oligopoly with 6 licensed taxi operators: Comfort, CityCab, Transcab, SMRT, Premier, and Prime. As I mentioned earlier, ComfortDelGro actually has 60% market share of taxis in Singapore. And one thing to note is that fares are not regulated by LTA, but they are the companies fix the fares themselves. Okay, historical industry trends. So we see 5 trends. Public transport ridership is growing. MRT is gaining market share of ridership from buses. There's a positive correlation between ridership and population numbers, and there's a higher ridership penetration within the population. Lastly, car population growth is slowing. Here you can see a time series of ridership numbers from 2001 to 2013. You can see that ridership numbers has been increasing. This is the same chart except it's been plotted by percentage. You can see that MRT, which is the dark blue, has been gaining market share, and bus, which is this green bar, has been getting shorter. There's a positive correlation between ridership numbers and population as well. And in addition, you can see that as the population grew, the ridership numbers grew at a faster rate. The relationship isn't a linear relationship. The chart shows the average ridership divided by the population number. So it's an indicator of penetration of public transport ridership within the population. And you can see that in the last 2 years, from 1.16 to 1.13, actually this 1.3 actually reversed the last 9 years of decline. Lastly, car population growth is slowing. You can see that although it's been growing, but the rate at which it's been growing has dropped steadily, and last year it just hovered close to zero. So a recap on historical trends. Okay, the outlook for the sector. First, see that population growth will create a natural demand base for public transport. How this is so is that through the introduction of new transport services around new residential and commercial developments. Next, government spending to increase capacity to meet with demand. The MRT track length is to double by 2030. And buses will increase by 35% through the BSEP, Bus Service Enhancement Program. Government initiatives and regulations make public transport more attractive through connectivity and reliability. Government is targeting 75% of all trips during peak hours by public transport. This is an increase from 59% in 2008. Aggressive government action to dissuade car ownership and steer commuters to use public transport. This is through a two-pronged approach, cost of ownership and cost of use, with COE and ERP as tools. The improved fare formula alleviates operating cost pressures faced by PTOs through the introduction of the new energy index component and rollover mechanism. And there's a regulatory carrot and stick where they have increased the penalty for rail disruption to up to 10% of revenue, and they've introduced a new service standard for buses. We also see impending changes to rail and bus models. It's long overdue, but it's in progress. Okay, last slide to give more information on what the asset-light model is in respect to the SMRT. So what we already know for the asset-light model is that the government will own all operating assets and lease them to the PTOs instead. PTO stands for Public Transport Operators. And so the government will be responsible for CAPEX, that is buying new trains for the lines and infrastructure. So what we don't know is how much will the lease be? Will it be better or worse than the current situation? And also, as I point out, that currently SMRT is enjoying a lot of profits from rental space from the MRT station. So under the new rail financing framework, we don't know whether they will still be granted access to the rental space. And why is it tricky? So firstly, this transfer of the assets back to LTA, before that they need to value the assets, and also they need to iron out the mechanism of returning the money. And from an electorate point of view, this would appear to be a government bailout for a listed company. And moving forward, the government, if the government owns the operating assets, the government will actually be footing the bill for the expenses such as asset depreciation and capex, and they are using public funds for this as well. Okay, we've come to the end of the presentation. We will now take questions.
Yeah. There's an earlier question on Porsche. Our view on Porsche and why did the share price didn't do that well in the recent listing on the SGX. Well, for Porsche, it has investment merits like first thing first, it's the largest Asia OSV provider and ranked top 5 globally. Second, it has an experienced management team, being the member of a Quark group. And thirdly, it has a fleet size of up to 125 vessels by 2015, up from 112 vessels currently. So all this actually implies growth for the company over the next few years. But having said that, for Porsche, its listing, its IPO price is actually fairly priced from our perspective. Its FY15 P is around 9 to 10 times, whereas its P for FY14 is around 16 to 18 times. So in a sense, it has been fairly priced in our view, and that's why the stock price is pretty muted recently. So, but all in all, Porsche is still one of the best companies out in the market. Investors who wants to go in should wait for a better valuation. Thank you.
Hi, so we have a reader, audience. He asked that our house highlighted UE a few months ago, highlighting the discount to NAV, and is a buy now. Okay, so since we highlighted somewhere around in November, it's went up 20%. So right now it's trading at price over RNAV of roughly 0.8 times. Meanwhile, we still don't see much developments. I mean, it hasn't really divested the WBL's automotive portfolio, and all the property assets from WBL is only the very small, maybe like 50, 60 mil kind. So right now we don't see much anymore upside from UE, even though if there's further corporate actions, then that might be a catalyst for the discount to close further. Yeah. So in short, our answer is no, probably not as much upside in the near term, since it's already 20% from our we first shared this idea. All right, thanks.
Hello. Hello, there's a question say based on the residential property action, developer need to sell within 2 years of getting TOP. Is HoBee affected? Well, we believe that for now, for at least for this year, HoBee is not will likely not be affected for this year yet. But next year, they may be as at the moment they are looking to lease the property. Whether the company will buy over the properties for investment to classify as investment property users, they are still looking at it. So at the moment we don't really comment on that at the moment, but hoping that by next year or so, if the residential properties market could actually improve, they should be able to start launching for the Sentosa Cove again. Thanks. Hello. There's also a question asked, what is the financial impact if not so? As per now, the gearing ratio for the for HoBee is at about 30% or so. We believe that if by then they are still not selling, it could be they will likely to buy over there and use that as property investment property accordingly. Is there any more questions on that? Anybody can
Hi, this is Richard. Okay, I'll answer some of the questions about the transport. First, what is TTM in TTM PE for SMRT presentation? TTM stands for trailing 12 months. There's a question about why bus business is making a loss despite 26 market share and taxi 13% market share making a profit. Okay, firstly, the two businesses fundamentally they're different. One is fare based, one isn't fare based. So for bus, they are earning revenue through the fares, but as you know, as the public transport operators, they are not able to set the fares. The fares are set by the Public Transport Council. As for the taxi, it is not, they do not earn revenue through the passengers who take the taxi. They are earning revenue through the hirers who hire the taxi from SMRT. There's a question about SBS Transit bus business compared to the bus business. Okay, yes, there's a question about to clarify whether the bus business of Comfort Delgro is from SBS Transit. The answer is yes. Comfort Delgro owns 75% share of SBS Transit. And the next question is that is the business making money? For SBS Transit, actually their bus operations is not making money, but the losses are offset by the advertising and rental revenue. And so net SBS Transit still records a profit.
There's a question on that Silver Lake actually replaced DBS on our top pick. So are we still positive on it was preferred to the banks, and is this still so? Actually, both were from our top pick because for DBS interim there was quite a lot of negative sentiment on its exposure in China. Of course, that has proved to be no longer, and the price has reversed itself. Silver Lake's price has not moved that much due to lack of announcement of contract of the much anticipated contract win. Net both I think were flat when we highlighted them, and they were taken off the top pick list. Actually, now we have OUE, which is replacing them because it is pretty undervalued with large cash balances, and corporate movements seem to be signaling impending projects. We still have M1 on the list. For data monetization, we see that there's going to be quite clear earnings growth for telcos, and M1. We also have Croesus Trust, a retail trust, is severely undervalued, about more than 8% yield, and there is earnings revision likely to come from rental revisions and its 2 new properties, which actually could push the yield double-digit. Okay, and we have Bowsit still on it for also being severely undervalued despite its strong run-up, and Pan United because of its Newport acquisition.
There's a question about what will happen if the SMRT train assets buy over by government. Firstly, SMRT would have to lease all the operating assets from the government. Operating assets will be things like the trains, escalator, lift, signaling equipment. So they would have to pay a lease. So now, while they are holding the assets on their books, one of the expenses that they see is the depreciation expense. But if they sell the assets back to the government and they pay a lease, then they would probably have a lease expense instead. So it's and what is the uncertainty now is how much lease is the government going to charge them? Is it going to be less? Is it going to be more? If it's going to be more, then it's going to be worse off for SMRT. And then if it's less, it means that actually it could mean that the government is going to use public funds to help a listed company. There's another question about what are the reasons for the share price surge for SMRT. We think that is a renewed speculation that the transfer of assets and the real financing frameworks will be happening soon, but other than any material announcements, nobody knows when it's really going to happen. There's another question about the target price for SMRT, 90 cents. We use a PE valuation. Here we see that the historic PE for SMRT had traded about at an average of 17.9 times. So based on our FY16 estimates earnings of 5 cents and then multiplied by the 17.9 times, that's how we get the 90 cents target price. Major shareholder, there's a question on who is a major shareholder for Temasek. Major shareholder for SMRT. The major shareholder is Temasek with about 54%. Yes, there's a question about the target price and 2-year horizon. Yes, that's the 2-year horizon.
I have a question on Sarin. Benjamin here, by the way. It's a recent drop of price. So last week there's about 5-6% price correction, down to about 267 from 280 odd. Yeah, I don't think there's any specific reason yet. There was a move was on no news, and there wasn't any change in substantial shareholdings, nor were there any insider trades. And I don't see any of the management disposing of their shares as well. So we see from our point of view, in our opinion, I think the price correction presents a great opportunity for accumulating discounter. As of our target price for Feb 1 year forward Feb still stands at 320. So currently presents about close to 20% upside. And just to reiterate, for Sarin itself, there's very strong growth in terms of recurring income, which will help to improve the gross profit margins with every incremental Galaxy machine that's added to its deployment. And Sarin will also release its first quarter results next Sunday, so we'll be giving you an update after that. And there's currently the Sarin Light and Sarin Load have been commercialized, so presents a very, very exciting road ahead. Right, thank you.
All right. This is Lucas here. Just to clarify some issues, I'm actually covering real estate here. So yeah, based on the, I think there's a few questions on the developer having to sell 2 years of getting TOP is will be affected. The answer is no. Okay, sorry. Let me just answer that to a greater detail. Basically, if you're talking about the condos on Sentosa, okay, they are not subjected to QC, so they do not have to pay an extension penalty. But having said that, okay, if they want to hold it as an investment property, as in that they want to transfer it to become an investment property holding and lease it out and whatnot, they do have to pay the taxes to do so, which is literally a transaction to a third party, and the relevant taxes involved, like the additional buyer's stamp duty and whatnot. They all have to. These taxes are all levied on them as per like an arm's length transaction. So this is something that the government has enforced on them. Even though they have given a waiver to the QC, they are not exempted from the taxes that is involved as per a normal transaction. Okay, hope that answers your question. Okay, developers that are unable to sell their units within the 2-year period have to pay extension charges of 8% of the property purchase price for the first extra year. What's the financial impact if not sold? Basically, when it boils down to how the management actually want to run the business. If they can just keep paying extension as per negotiated with the government, even after 2 years, they can still cite the fact that they are unable to sell the units and it's still up for sale, and if they want to put it on they still want to put it up for sale, they will basically have to pay further extension charges. Alternatively, as per what I said, they can transfer it to become an investment holding and lease it out. The thing about it is, if you are under the QC, you are unable to concurrently do both of it. So you literally, if you want to transfer it to your investment properties, you pay taxes and then put it up as an investment property and lease it out and get rental income. And when it's time for sale, you just reclassify it in your balance sheet and then basically sell it away. So I hope that also once again answer your question. The management obviously have certain business plans in place, but we are unable to actually point out the exact timing in which they will start to switch the way they classify their properties. And yeah, Sentosa Cove projects are not subject to TOP penalty. I think it's more of the QC rules. So yeah, that is covered. In evaluating the possibilities of delisting companies like SC Global, what's the analyst's view? Possibility of delisting, we don't really have a very strong outlook on that. Basically, right now, majority of the property companies are still undervalued. So the guys behind these companies, the backers of these companies, okay, will always be on the lookout of how to unlock the value. I think that this question arises from, I think, Sealand trying to delist CMA and yeah. So basically, it actually had to make business sense for them. It must be value accretive to the parent group for them to even want to consider such a move. That's one. And secondly, it must be beneficial for growth reasons, like maybe they have certain potential assets to be injected further and they can do it better when it's off the market and whatnot. So there's really a lot of reasons why this can happen, and for the large part, okay, such delisting is very costly to the parent. So yeah, we do not see really very heavy flow on the number of delisting that's going to happen. The follow-up question about, on HoBee, will it be a better option to delist HoBee as compared to the other options to lease? Once again, the opportunities lies with the management. So we are at this point in time, I don't think anybody except the management knows what the opportunity that they're looking at. I don't think that we can actually give you a very we can't foretell the future on this specific aspect to delist HoBee or not. But we do not think that is going to be the case for now. Yep. Okay, just another question. Wing Tai and Wheelock affected by QC selected properties? It is for the most part those any company that is listed, they definitely have a range of shareholders. Any one of them that is non-Singaporean means that the company will be subject to QC for developments in the islands itself. So yeah, I would think that the answer to that is yes. Yep. All right. So with that, we have come to the end of today's presentation. Thank you guys for your patience and start when there's some technical difficulties. We hope to be able to avoid that in the next week coming forward. Thank you.